Welcome back to course number 4, Understanding Credit and Debt. In this lecture, we'll focus on three of the most common types of borrowing that college students encounter: credit cards, personal loans, and student loans. By the end of this session, you'll understand how each of these works, their benefits, their risks, and how to use them responsibly. Credit cards allow you to borrow money up to a certain limit for purchases. They are very convenient and can help you build credit history when used wisely. But the catch is interest. If you don't pay your balance in full every month, you'll carry debt forward and pay interest charges, often at high rates. The advantages of credit cards include convenience, fraud protection, rewards like cashback or travel points, and the ability to build a positive credit history. However, the risks are real: high interest rates, late fees, and the temptation to overspend. Carrying balances can lead to long-term debt. For example, a $1,000 balance at 20% interest could take years to pay off if you only make minimum payments. Loans are another common form of credit. With a loan, you borrow a lump sum and agree to pay it back in fixed installments over time, usually with interest. Examples include car loans, personal loans, and mortgages. Unlike credit cards, loans typically have fixed terms and repayment schedules, which can make them easier to manage if you budget carefully. The benefit of loans is that they allow you to make big purchases, like a car, without paying all at once. They often have lower interest rates than credit cards, especially if they are secured by collateral. The downside is that loans are long-term commitments. Missing payments can damage your credit score and sometimes lead to repossession of assets, like your car or home. For many college students, the largest debt they face is student loans. Student loans can come from the federal government or private lenders. Federal student loans often have lower interest rates, flexible repayment options, and borrower protections like deferment or income-driven repayment plans. Private loans may cover gaps in tuition, but usually have stricter terms and fewer repayment options. The key to managing student loans is to borrow only what you need, not the maximum amount offered. Understand the terms before you sign: interest rates, repayment start dates, and whether interest accrues while you're in school. After graduation, make payments on time, and if possible, pay more than the minimum. Many students also choose income-based repayment plans, which adjust payments based on earnings. Remember, defaulting on student loans can have serious long-term consequences, such as wage garnishment or damaged credit. Let's quickly compare. Credit cards are flexible but risky if balances aren't paid off. Loans provide structure with set payments, but can lock you into long commitments. Student loans are designed to invest in your education, but require careful planning to avoid overwhelming debt after graduation. The common thread is responsibility: borrowing only what you need and repaying consistently. To wrap up, credit cards, loans, and student loans are powerful financial tools that can help you meet short-term and long-term needs. But they can also become heavy burdens if not managed carefully. By staying informed, borrowing wisely, and sticking to repayment plans, you can use these tools to support your goals rather than hold you back. This concludes our discussion about credit cards, loans, and student loans. In the next lesson, we will learn about the impact of interest rates and minimum payments. See you then.